NIO closed Friday at $6.86, down about 4.1%. On the surface, it looks like another rough day for a Chinese EV name, another hit in the broader tech ADR weakness. But here's the nuance: the drop had almost nothing to do with anything new at NIO. Instead, this was a macro sector event, and once you peel back the layers, it's actually a constructive setup for what comes next. Starting with the obvious, the Nasdaq sold off, tech and growth names were under pressure, and the entire group of US-listed Chinese companies, especially in EVs, took a hit. That alone puts NIO's decline into context. It wasn't that NIO missed earnings, or suddenly cited weak demand. The reality is broader risk-off sentiment pulled it down. Then add in the ADR-specific risk. Investors heading into a weekend don't want heavy China exposure in the face of political uncertainty, tariffs, regulatory risk. Add in the fact that NIO has an ongoing lawsuit with Singapore's GIC and lingering profitability questions, and you get a cocktail of better safe than sorry selling. But again, important note, the lawsuit was nothing new. It was already known. No fresh bad headline, no surprise guidance cut, no new delivery miss. When a stock drops in that environment, no fresh negative news, no company event, moderate volume, it tells you something important: the selling isn't about the business. It's about sentiment, rotation, technical triggers. And that distinction matters, because it means the underlying story may still be intact. Now, let's look at what is going on at NIO. Back in October, NIO delivered a record 40,397 vehicles, up approximately 92% year-over-year and up about 16% versus the prior month. That kind of momentum doesn't vanish when the stock dips. In fact, the company is entering a ramp-up of its key SUV model, the all-new ES8, whose production capacity is set to rise by about 70% in November compared to October. That's a meaningful update and one worth watching closely. CNEV Post Plus 2 EV, everything around EVs plus 2. Imagine this: the business is executing. Deliveries are climbing. Production capacity is accelerating. Yet the stock just got pulled back not because of anything wrong, but because the market hit the risk-off button. That's a critical observation because when markets trade like that, when a stock is punished for things it didn't do, often the subsequent rebound can come when sentiment normalizes or when a new catalyst emerges. Let's dive a little deeper into the mechanics of what happened today. NIO broke below the psychological level of around $7. That triggered stop losses, algorithmic hedging, short-term momentum selling. Once that level broke, the stock was vulnerable to mechanical selling, not driven by corporate news. Volume today was moderate, not spiking. That means the big institutions weren't running for the door. They were adjusting positioning. The algos did the heavy lifting. And that creates a scenario where the downside is limited until there's a real trigger for the upside. One of the interesting behaviors in recent weeks is that retail sentiment for NIO has cooled a bit. There weren't massive retail buy flows this week. But importantly, there weren't frenzied sells either. A neutral sentiment with moderate volume after a decline like this is a healthier setup than a panicked meltdown. It suggests consolidation, the market pausing, absorbing information, resetting. So what does all this mean for next week? Why should investors pay attention rather than dismiss this dip? Because we're entering into a territory where catalysts could align. First, with the ES8 production ramp-up, if the company begins to hit high-volume production or gives guidance that margins will improve, that will matter. Second, if NIO provides any update on profitability, we know the market is skeptical about when the company shifts from volume to profit. A positive surprise there would change sentiment quickly. Third, international expansion remains underappreciated. The European rollout, export strategy, battery swap network growth all remain tailwinds not yet 100% baked into the share price. Now, some people will say, but if so much is already known, record deliveries, ramping production, isn't the upside limited? Yes, that is the core of a bearish argument. But the mistake often is assuming the market fully understands how growth compounds. When a company goes from 20,000 units to 40,000 per month, from limited capacity to a ramp of plus 70%, the earnings math can shift dramatically. And the services ecosystem side of NIO, battery swapping, software, subscriptions, is something that rarely gets priced in early. It's also worth noting that when a stock drops because of macro noise, the window of opportunity opens for those who believe the fundamentals still matter. Stocks punished for reasons outside their business tend to outperform once the market shifts. That's not a guarantee, nothing is in investing, but a setup where the risk is more about sentiment than the company can offer a compelling risk-reward asymmetry. Of course, I'm not saying NIO is without risk. The EV market in China remains intensely competitive. Margins are under pressure. Regulatory or export risks could flare. But the key point is, those risks are known, not suddenly emerging. And when the market is ignoring growth momentum, that's where opportunities appear. If I had to summarize one takeaway for you, today's drop is a pause, not a breakdown. NIO is consolidating after a run, and because no business-specific disaster hit, the probability of a rebound in the next weeks is meaningful, especially if any of those catalysts line up. For viewers, if you're a long-term investor, this week's action offers a moment to reflect rather than panic. Are you still committed to the thesis of NIO as an ecosystem player in electric mobility, with multiple brands, a service infrastructure, and a growing international footprint? If the answer is yes, then this could be a setup moment. If you're a shorter-term trader, watch for signs of reversal, a spike in volume on a breakout above $7.50 or $8, positive margin commentary, or export orders announced. As we wrap up, one final thought: markets are emotional. They love new highs, big surprises, and hype. But they dislike uncertainty and status quo. Today, NIO's fundamentals stayed the same. What changed was sentiment. The good news is sentiment usually recovers faster than fundamentals shift. So don't dismiss this drop as a negative story. Consider it a lateral move in a trending setup. Thanks for tuning in. If you found this analysis helpful, please hit the like button, subscribe for more EV and tech stock breakdowns, and leave a comment below. Did you see today's drop as a buying opportunity or just part of the macro mess? Enjoy your weekend, and I'll see you in the next video.